This month was horrible because we almost didn't pick anything, and we probably shouldn't have. But we have the silly rule that for you guys, we are picking a stock a month, every month, regardless of economy crashing, stock markets doing stupid things, layoffs, all that stuff.
Trying to pick a stock during a recession is like dragging your face through a cheese grater. It's not very fun. And that's this month. And we've talked about the zombie apocalypse in past videos. I don't know how many
It's
videos.
coming.
It's coming.
Get your zombie packs, because it's coming.
The problem with this month, and the reason why we almost didn't buy, the Fed is still raising their rates. We talked about the real estate crashing. Right now, there's 750,000 people out there that are behind on their mortgage. 2 million people that are starting to get behind on their mortgage. That's of December. And the Fed is still raising their rates. Now, if you look at the actual sale of homes, what's happening with the market there is it's slowed down, at least in our area, more than it has since 1996 in this area. Now, we're in Michigan, so that could be different for your region, but what we're seeing across the board and across the United States is that's happening everywhere.
Yeah, if you take an aggregate of all the states, you're seeing a slowdown.
Plus, there's layoffs, and there's a lot of them. The tech sector alone is almost 60,000 people. It's like 57,000 people.
Yep.
There's 100,000 overall layoffs, and we're like 3 weeks into January.
Yeah, this is just the beginning. There's going to be more layoffs.
Yeah, so this is just the start of it, and all the financial reports are due in week 3, and we're looking at a lot of those. So the company that we purchased, we looked at the financial numbers, but they also publish things like GDP, what's happening. The Fed posts all these things about what's happening with consumer discretionary spending. And the report that came out this week was terrible. It was really bad.
You people aren't spending enough.
There's no discretionary spending is the problem. So you see this thing that comes out and says, hey, GDP grew 2.9%. It did, but if you had like $120 and that was your discretionary spending and you got a pay cut for, $100 or something like that. So now you've got $120 left over. And you cut your discretionary spending by, let's say, $105. So your pay cut was $100. Your discretionary spending was cut by $105. According to GDP, your income would be better off even though your quality of standard of living is lower. That's what these numbers are doing. It doesn't look good. Consumer discretionary spending has dropped more now than it has since any time in history except for during the Great Depression in 1932.
In U.S. history.
U.S. history, yeah. So, we're not talking about like Constantinople or the Roman Empire here. But these are all indications of a market that is the bull inside of the bear market. Like it's going to come back up. Now, there are some things that might make it better. The Fed could taper the rates. They could stop raising their rates. And
right.
the way to find out and the way to get more bullish on that is to take a look at treasury yields. Look at the way equities pay their investments and look at treasury yields. If treasury yields start tapering off, then you can say, hey, it might be a little bit time to be positive again. But right now, we're all about the zombies or the stocks that are going to go down. When that happens, in my personal portfolio and Brian's personal portfolio, we tend not to buy anything.
Right. I want to hang on to that cash and hold it over and let it grow until the market equalizes and I see the opportunity to buy. And then I have more cash to actually buy instead of, oh crap, I put so much money into that, I have nothing to buy now that it's a great time.
Benjamin Graham, Warren Buffett's mentor, and Warren Buffett himself have said you wait for the fat pitch. So that's kind of what we're getting at, is we're waiting for market indication to actually show some stability. It's very volatile right now. There's not a whole lot out there that looks good on paper right away. Now there's some things long term that look okay. Of those stocks, we decided that because we never invest and we never do our research and we just don't typically do anything that's any kind of knowledge-based investing, we're going to flip a coin. Or a POG. POG. We're flipping a POG this month to buy a stock.
So we've been looking at 3M and IBM.
And International Paper.
And International
Intel,
Paper.
And about 50 other stocks.
We only have 2 sides, so we can only do 2. So 3M will be the skull, and the blank side, or black, would be IBM.
Does that skull mean if I buy it, it goes down like 20% like AT&T?
Like everything you buy.
What? Oh, wow.
All right. Hey. No. No. Hey, 3M.
We're buying 3M.
We bought 3M. We're buying 3M.
Why are we buying 3M? It's a bear market. It's gonna crash.
Okay.
Brian.
Yes. So disclosure normally in these situations, like we said, we wouldn't buy anything. And maybe we'll go through at some point and change our rule that says we have to buy something or put money into an existing stock that we already have.
Put like 40 hours of research into these companies. It's down to like a coin flip.
Right.
Going, whoa.
It could be IBM, 3M, either one would have been fine. We bought 3M because we are looking for the recession play.
Yep.
It doesn't look great. No stocks really look great right now, but of the terrible stocks, this one looked like it could weather the storm and be a better long-term play. Plus, they make a ton of products. So during the recession,
You got a boss that you don't like, they can wrap them up in 15 different kinds of tape.
yeah,
Don't do that to me.
horrible bosses. Or airlines, they love duct tape. 3M makes it.
Why do airlines love duct tape?
Help!
Needed with some heavy-duty tape and plastic ties.
So yeah, when the recession comes and we're in it, and it's going to get worse, especially if the Fed raises that rate, and it's going to cause pressure on everybody else. 3M makes a lot of the products that you really need to buy and keep buying through that.
Roofing materials, tapes, chemical products, paper products, a lot of industrial stuff. They make a lot of stuff.
Right.
Why 3M over IBM? There's a lot of reasons. It's not just a coin toss, I hope.
No, the
Or
hog toss
hog
was,
toss.
it was fun, but
So-
it's not really how we make decisions normally.
Analysts, we know the analysts are negative. We know that Jim Cramer's bashing on 3M and Microsoft and the others. He seems to like some aspects of 3M. We know there's lawsuits. They know they cut the 2,500 jobs. We know that they missed their earnings reports. We know all that. We've seen it. We can post on the
There
screen.
is a lot of negative, but
But if you look at their net income over the past 9 years, and you're going from what they were doing back in 2013 all the way till the end of 2022, 9 years of earnings reports, there's a consistent positive trend.
Right.
And if you look at what they're doing trading to their trailing earnings, or the 15-2-week trailing earnings, price to earnings ratio, it's low. They're cheap right now. That's a good thing. Over the long term, they're trading relatively cheap to their earnings. Do I think that if you're going to buy this stock, you're going to go, oh my God, it went up to the moon 50%. It's like crypto. It's going to, no, it's not going to do that.
Most likely it's going to go lower.
It's like my AT&T buy. We're going to buy AT&T. Stock month one drops 10%.
Just as a disclosure, if you buy this when we're buying it today is the 27th of January. If you buy it today, just expect that it's probably going to drop, and maybe buy more as it drops, but it's going to drop, but we're fairly confident that it's going to go back up in a few months.
When you're looking at the price of a stock, there's other things to accommodate for what the market is doing. You need to look at the book value, the assets, the liabilities, operating income, the total revenue that the company's making, the diversification of the products, and how things like supply chain affect them. These guys got hammered by the supply chain. Johnson & Johnson is there too. They need to figure out different ways to make product, but the underlying business model and the defensive moat they have for the products they have is a good one. Sure, short term, they might not look that great. AT&T, when we bought AT&T, go all the way back to our first videos, I apologize, we know they're awful, but we're going to keep them there just so we can make fun of them over and over and over and over again. But if you go back to that one, we bought AT&T because we saw some positive trends in their customer base. We saw that they were going to be growing their customer base. By the time we bought it, the stock dropped like 11%. Oh my gosh, it dropped 11%. And over the next 2 quarters, they showed like they gained 7 million new subscribers or customers, if you will. And the stock recovered.
It's starting to come back, yeah.
Yep, and their dividend paid us the whole time. So when we're buying 3M stock, and like I said, we almost bought nothing. Because the markets doesn't look really good right now. So you want to buy a company that produces products that people have to have. 3M is one of those companies. Even if it drops a little bit and trending with the rest of the market, it's probably not going to drop that much. In defense of 3M as well, they have a pretty large, solid customer base, and that's not going anywhere. In addition to that, if you look at their dividend history, that's very stable. This company is not an exciting company, but it is a company that's going to protect your asset and your investment for a while. Plus, we didn't have anything in the paper sector's industrial sector in the portfolio itself.
Right. It diversifies our portfolio, has a decent dividend of 5.25, so that's going to raise our portfolio by about $23 and $2 per month. So
we're up to $205, I think, per year.
208 maybe, somewhere around there. We'll run the numbers and put it up here.
So it's not a lot, but it's still getting better.
It's a faithful stock. It's going to be around. It kind of has a steady up and down cycle, so it's somewhat predictable. As far as diversifying our portfolio, this was
it.
one of the best ones we can pick.
Yep.
If you put a gun to our head and said pick one.
That's kind of the way it was too.
Yeah.
3M stock is a diversified company within our portfolio that we needed to pick to get a good industry balance. There's other stocks you can buy. You could say, well, Tom, why aren't you buying mining companies? Because the automotive industry is all going electric. Why aren't you buying energy companies or the oil companies? Well, we have those in our portfolio. You don't want to leverage too hard against one company, because if you'll notice, if you're following along and you go back in time, we have companies that, like Devon Energy used to be our best performer. Now it's kind of in the middle. You got to take with the ebb and flow, because what happens?
Right.
Large investment firms, large shareholders, if you're talking Vanguard, Fidelity, the big ones out there, and you buy a stock and you want to try to day trade, they will use your cash as liquid leverage.
Right.
So don't play that game. You're going to lose money doing that. So,
and again, you're playing the snowball dividend income game. You're playing for the long term. You're keep investing into it. The dividends are going to keep reinvesting into it, into different stocks. And it's just going to build over time. And that's our mantra.
In 3M's case, that mantra plays well because they're trading back to 2013 levels. And if you go back to 2013, even if you go back 5 years, you go back to 2017, 2016, if you look at their earnings there's a steady incline year over year.
Yep.
And they're trading prior price to those earnings. Go back to book value. You go back to the accountant behind the vaccines crunching the numbers, the person with the librarian glasses. It's not me.
All right.
But you go back to that person. Oh, I can't see anything. and so that person is going to say, hey, these numbers look more favorable. When we're trading that with 3M looks pretty good relative to those earnings in historical fashion. We're in a bear market. Don't buy it with the anticipation you're going to make money tomorrow. This is a long-term play.
Or don't buy it at all and just hang on to your money. Put it into a 4% interest account and hold on to it for another month and see if the economy comes back. Or just keep doing that. And then you have money, so when it does reach bottom, you have more buying power.
Getting old, man. I can't see any of all these. It's not good. Brian's right. There's on the Ameritrade platform that the Dividend Dudes portfolio uses, and E-Trade's got this too, Fidelity's got this too. If you have a cash in your balance, you'll notice that our portfolio has a lot more cash. We just put a bunch of money in there so that we had money to buy the stock once per month, but that cash is in an index fund it's backed, it's insured, so you're not going to lose your principal, and they give you a base. It's kind of like a CD. So you can do that with your cash and you can wait, but don't do that for too long. Right. Because of inflation. If you sit it there too long and the interest they pay you for that money that you put in there in the index fund, it's going to be lower than what you could get otherwise in just a simple dividend check.
Right, and plus thanks to the Fed, it's up to a little over 4%, which is great, but inflation's still 8%. So you're still not making money off that, but you're not losing as much. It's a short-term play to keep your money safe and to grow it a little bit. So when you do buy, it's there. Just make sure, unless you absolutely need to spend that money, don't spend it.
Right. So what's next? We're looking really closely in the technology sector. There's only a few more sectors that we can get into before we're fully diversified, at least to our satisfaction. The real estate industry, the banking industry, there's a few more industrials that we can look at. But right now,
tech sector.
Tech sector. We're looking at that next as a tech sector. So IBM, Intel, those kinds of companies to see what's going. Again, this is a bear market, so you have to be careful knowing going into it that this is going to have to be a long-term play. So don't gamble with your money. Invest for the long term, so make sure that what you're investing with is money that you are okay with losing. Now, if you look at our portfolio, $205 a year in income. We're still beating the market. We're still doing very well.
We are.
We've got pretty good sectors in there. Now, again, you're going to notice that wave that comes in with every stock. So 1 month we had Devon Energy doing really well, and RIO wasn't doing so great. Now RIO is doing really great, and Devon Energy isn't doing so good. You have to balance it out, and that's why you diversify. There's a plan, and there's a way that we go about investing that takes advantage of that wave that happens that we're going to get into later. But you got to tune in for future months to see what we're doing with that later, and it'll be good. You'll like it.
It will be. And listen, if you find value in the videos that we're making, then go ahead and like, subscribe, comment, give us, even if you do a thumbs down, that's still engagement. for the almighty YouTube algorithm, and Lord knows we need it. So
We hate you, Tom. Why wouldn't you? He doesn't ever shut up. Thumbs down. Hey, more engagement.
exactly.
What we're hoping to do is we're hoping to monetize the channel over time so we can put more time into the stock analysis, make the videos a little bit better for you, and then actually if you guys subscribe to the channel and want us to analyze the stock for you, we can have time to do that. It's really difficult to do that while we're running the company and doing other things, so this is kind of on the house.
And we appreciate all of you for joining us on this ride, and we appreciate every single one of you. Thank you.
Yes, we do. Thank you very much.
And as always, happy investing.